Let's go ahead and start. Okay, if we can bring this meeting of the Sac Metro Finance and Audit Committee to order for February 28th, 2019. And the first item on the agenda will be a public opportunity to discuss matters of public interest within the committee's scope, including items on or not on the agenda. Do we have any speakers?
There are no speakers this evening.
Okay. Moving then to the consent agenda, and we have one addendum to that. Prior to this, I'm going to turn this over to Chief Castantini for an announcement.
Yes, good evening, directors. Due to an oversight, an incorrect value was noted on page 16 of the Finance and Audit Committee packet in regards to item number 3 on the consent agenda. On page 16, the total pooled investment fund with Sacramento County was listed as $40,818,899. However, the correct loan value is $49,981,272. Copies of the corrected page 16 have been provided to the Finance and Audit Committee and are available on the public information table in the boardroom. Thank you.
Thank you, Chief. With that, do I have a motion on the consented agenda?
I make a motion.
Have a motion and a second. Would you call a roll?
Director Salers?
Aye.
Director Orzali?
Aye.
Motion passes.
Moving then to the presentation items. The item 1 is the financial report through December 31, 2018, and CFO Thomas will be making this presentation.
Good evening, directors, Chief Castantini. The first presentation this evening will be the financial report for the 6 months ended December 31st, 2018. So that's the first 6 months of our current calendar, or our current fiscal year, 2018-19. So the first chart that we're looking at here shows the district's cash balance as of December 31st, 2018. The green line depicts the current fiscal year, and the red line depicts the previous fiscal year. And you'll see that the cash balance of negative $41.6 million is lower than we were showing earlier this year, and also lower than where we were at the same point in time in the previous year. And the primary reason for that is that in November of 2018, the district redeemed $25.5 million of outstanding pension obligation bonds. So it was the Series 2004C, and that was done in accordance with the district's pension bond policy, whereby the district had set aside money every year in order to be able to pay off those bonds at their conversion date in 2018. And similarly, according to that policy, we are continuing to make deposits to that stabilization fund that will be used in the future to pay off the Series 2004B bonds in 2025. So the reduction in cash balance is the result of that stabilization fund money being used to redeem the bonds. So there was also a reduction, obviously, in the district's outstanding debt corresponding with that to a $25.5 million redemption. But that explains the drop in the cash balance. The other thing that I will note is because here we are showing cash in all of the district's funds, not just the general fund, but this is actual cash in the fund. And as of December 31st, we had not received the deposit of the first installment of property tax revenues. You'll see that revenue is recognized as revenue because it was earned in December. So when we're looking at the revenue charts, it will be reflected, but it was not actually deposited in December. It was deposited in January. So you're not seeing it on this cash chart here. But at the next report, you will see that uptick similar to the uptick that we have in the red line in January of last year. Moving on to look at revenues, this chart shows medic cost recovery revenues. And just a reminder, when we're looking at these revenues during the year, what we're reporting are our actual collections on a monthly basis. So you can see that halfway through the year, we've collected about $17.9 million. That's shown on the red line. That's the current year actual collections. The blue line is showing us our fiscal year budget for a total of $35.5 million. And you can see that the red line is tracking really right on track with that blue line. Halfway through the year, we've essentially collected half of the budgeted amount. And the green line is showing us last fiscal year. And if you'll remember, last fiscal year, early in the year, we were trending below budget and really picked up in the second half of the fiscal year as the rate increases started to be reflected in the collections. So you'll see that there's a narrowing of the distance between the green line and the blue line as we get into the second half of the year. This chart is showing total revenues, so including the medic cost recovery revenues that we just looked at, as well as our property tax revenues and all other revenues in the district's general fund. You can see that, as I mentioned, we are showing an increase in December as a result of the first installment of property tax revenues. So total revenues through December 31st are $108.4 million. And you'll see that that's tracking really right along with the budgeted number. So again, red showing current fiscal year actual and the blue line showing current year budget, with the green line showing the prior year actual revenues. Looking at our expenses, this chart shows salaries and benefits expenses. Again, red line, current year actual expenses. So $89.9 million through the end of December. That blue line is showing the budget, so a total budget for the fiscal year of $173.6 million. And you can see, again, the red line right on track there with the budget line halfway through the year. And then the green line showing the prior year expenses. This chart's showing us total expenditures, so our salaries and benefits, services and supplies, and then other expenditure categories. Again, red line, halfway through the year at $107.8 million. Also tracking pretty closely to that blue budget line, which is a total of $209.3 million for the year. And you can see how we're comparing to the previous year, which is the green line on this chart. So this chart is showing us our general fund reserves. And the way that reserves are calculated is we take our starting reserve balance, add in all of the revenues that we're recognizing so far this year, subtract all of the expenses that we're recognizing, and that leaves us with the current reserve balance. So that blue line, you can see as of December, we are right about $25 million, which is also happens to be where we're expecting to end the year based on our budget. So that's reflected by that yellow dashed line, expecting to end at $25 million. And the red line is showing us the prior year. And the biggest reason why we are at a lower reserve amount at this point in the year this year versus where we were last year is that last year, because of some of the changes that were happening with the federal tax reform, there were a lot of people who paid all of their property taxes in December because they wanted them all to be paid in the current calendar year. So rather than waiting and making that second installment, there were more people that paid all of it up front in December. So we had proportionately more property tax revenues hit in December versus April last year than we would expect this year or in any other year. So that's really accounting for the difference there. When we look at this chart, what we're showing here is the balance in the SERPT fund or the district's OPEB trust fund. So this is a fund that is not held by the district. These amounts aren't reported in any of our other fund balances or the cash balance that I showed you. But this is a fund that the district deposits to for the purpose of paying future retiree medical premiums. This fund it's managed, the investments are managed by CalPERS, and the use of the funds is restricted for that purpose. So we really report this separately as the balance in the district's OPEB fund. And as of December 31st, 2018, that balance was about $35 million. To put that in context, The district's net OPEB liability is about $270 million. So this is the amount that is offsetting the total liability to get to an approximate $270 million net OPEB liability. You can see that over the life of the district's participation in this fund, so since we have been pre-funding the OPEB benefit, that we've earned about $3.2 million in investment earnings, and we've contributed about $31.9 million. So in summary, revenues and expenses are generally on track with the amounts that we expected for the first 6 months of the fiscal year. Overall, revenues exceeded expenses by about $700,000 for that 6-month period. The lower cash balance this year reflects the redemption of the 2004 C bonds in November of 2018. And our general fund reserves are consistent with prior year levels and expected to be $25 million. And that concludes this presentation. I'm happy to take any questions you might have at this point.
Amanda, I did have a question.
Sure.
When we were talking about the collections, what percentage of our collections are we able to recover?
Are you talking about medic cost recovery?
Medical cost recovery, yeah, thank you.
Right. So, so if you'll remember from some prior presentations that I've given the board, there are set reimbursement amounts for patients who are covered by Medicare and Medi-Cal that are lower than what our charges are, and actually lower than what our cost to transport somebody is. So as a result of that, we don't recover the full amount that's charged, and we recognize that we won't recover the full amount that's charged, which is why we set charges at a rate so that overall we can recover our costs. I want to say that if you look at the amount charged versus the amount collected, it's probably about 30% recovery, something in that range. But again, we understand that charged amount won't be recovered for a large percentage of the population being transported because of the coverage.
Understand.
Yeah.
Okay, thank you very much.
Sure.
Any other questions? Okay.
Okay. If there are no other questions, I can move on to the next agenda item.
Yes.
Yes. So this item is a presentation of the recommended mid-year budget for fiscal year 2018-19. So this is being presented to the Finance Committee for any questions or input that you may have before the recommended budget is presented to the board for approval on March 14th. So just a little bit of overview on the process. The mid-year budget adjustments are based on our second quarter budget review. So we're looking at the actual results through December 31st, 2018. So what I just went over with you. But all of the division managers are looking at that for all of their accounts on a very detailed basis. And then we're also looking at what are our projections for the remainder of the year, given what we know now that we didn't know when the final budget was adopted. And, as you just saw in the prior presentation, I think generally we are on track with where we would have expected to be. So the changes that we're talking about, I think, in the grand scheme of things are sort of relatively minimal as a result of that. Overall, the general fund budget is balanced, meaning that our expected revenues and transfers in equal, essentially, our expected expenses and transfers out, which is essentially where we are with our current adopted final budget and also where we're recommending to be with the mid-year budget. One thing that I've noted on this slide that we will have as a result of the FLSA settlement that was recently approved, we'll have about $1.4 million in settlement payments that will be issued. Those were recognized as an expense in our financial statements in fiscal year 17-18 because that's when we were aware of the expense and had the commitment of the expense. However, they were not accrued with the county, so we will need to, in our budget resolution, add in that appropriation so that those payments can actually be issued by the county, but I wanted you to be aware that they were recognized as a 17-18 expense, so they will not be reflected as an 18-19 expense in the district's financial statements.
And the source of that money, where in our budget does that money come from?
In our labor budget, so
Okay.
it was paid out as labor expense in 17-18, or it was recognized as labor expense in 17-18, although it was not actually paid out in 17-18.
And does it have any effect on our reserves?
So it reduced our starting reserve balance because we recognized that expense last year. So our starting reserve balance for 18-19 was lower as a result of that.
Okay.
Okay, so this table is showing in the first column what our current approved final budget is for fiscal year 18-19. The middle column is showing our recommended mid-year budget for 18-19, and then the far right column is showing the variance between the two. So if you look at the total revenues number, you can see that we currently are budgeting for revenues of $202.9 million. We're recommending a revenue budget of $204.8 million for an increase of about $1.9 million between current budget and recommended mid-year budget. Going to look at the total expenditures line, we currently have a budget of about $204.3 million. We're recommending a budget of $206.1 for an increase there of about $1.8 million. So you can see right there that our revenue and our expense changes are, very similar in terms of magnitude, essentially offsetting each other. Looking in the other financing sources uses down towards the bottom of the table, this is where we're reflecting the transfers that are coming in from the IGT fund. So that's what that transfer in line is. And you can see here we have an increase from final to mid-year of about $500,000, and that's just due to additional revenue that came in fiscal year 17-18, which is being used in the 18-19 budget. That is almost entirely offset by increases in transfers out to the Capital Facilities Fund and the Leased Properties Fund, which I'll go into further on in the presentation. But you can see overall, if you look at the bottom line, revenues, less expenses, plus transfers, we're currently at a negative $84,000. The mid-year is about $8,000 more in revenues and transfers in than expenses and transfers out. So we actually have a little bit of an improvement of about $90,000 between the two. So looking a little bit more detail at these recommended changes. So our total general fund revenue budget would be a recommended increase of $1.9 million, as I said, to a total of $204.8 million. The largest component of that is additional deployment reimbursement revenue of $1.1 million. So we did budget for deployments in our final budget based on what our prior year experience had been. But what we are seeing is that we have more of that activity this year than we did last year. So we're adding an additional $1.1 million in revenue. That does get offset partially by an additional $800,000 that will be added to the labor budget and expenses. And then on top of that, we're looking at an additional about $400,000 in property tax revenue based on what we saw in the first installment. It looks like we'll get a little bit more than we had budgeted for. So that's that adjustment of $400,000.
Amanda, the question for you, in the deployment funds, does that cover things like the fires? Obviously it's fires, but I mean, are guys going in strike teams?
Yes, absolutely.
Okay.
That's what that is. Thank you for clarifying. Okay, so looking at the expense adjustments, first looking at labor costs, overall we're recommending a $1.2 million increase in the labor budget to a total of $174.8 million. As I said already, and the largest component of that is this additional $800,000 for deployment personnel expenses. And then in addition to that, we have about $400,000 for flex medics. So these are two 12-hour units that are being operated with overtime that began in January. So we're reflecting that additional expense in the budget. And then there are a lot of other changes that happened within the labor budget, but they essentially wash each other out. So as I've talked about before, when we develop our preliminary and our final budget, we assume that all of our positions will be filled. And so we budget for the wages and benefits costs of full-time positions as we move through the year. And when we get to mid-year, we kind of do a true-up of, okay, what have we actually experienced so far this year? And let's project out the rest of the year based on our actual experience, which results in some savings in those wage and benefits lines, but that gets offset by increases in the overtime lines because we essentially still have the same number of spots that need to be filled every day. We're just filling them with overtime as opposed to full-time positions. So we have about a $6.2 million savings in those full-time position costs that's offset by about $6.1 million in additional overtime costs. Looking at some of the other general fund changes, so we're recommending an increase in the services and supplies budget of about $600,000 for a total in that budget of $27.8 million. The largest component of that is $300,000 related to additional vehicle maintenance costs beyond what was anticipated at final budget. That's partially offset by insurance proceeds because some of those repairs are covered by insurance. Some other changes are we have that $300,000 increase in the required transfer to the Capital Facilities Fund, a $200,000 increase in the required transfer to the Leased Properties Fund, and I'll talk about each of those separately. And again, those are essentially offset by a $500,000 increase in money that's coming in from the IGT fund. So those transfers are essentially washing each other out. So the adjustments in the Capital Facilities Fund that are resulting in that $300,000 increase in the transfer from the general fund are that the debt service is reduced by about $400,000 because of the timing of capital lease financing that would happen this year. So because we didn't do that in the first half of the fiscal year, we won't have a payment this year. And so that means that we'll have a budget savings this year. Obviously, we will still pay that debt service. We'll just pay it in a future period as opposed to this current budget year. We do have an increase in capital outlay of about $500,000, but that's partially offset by increase in financing proceeds of $300,000. So essentially, there's $500,000 more in equipment that we've identified a need for. However, we're going to be financing $300,000 of that $500,000. So the net impact there is about $200,000. And then also a reduction in proceeds from the sale of assets of about $500,000, and that's due to both the timing and expected proceeds from some of the surplus district property that's for sale. Looking at the Leased Properties Fund, the adjustments in this fund that are resulting in the additional $200,000 transfer from the general fund are a reduction in rental income of $300,000, which is partially offset by a reduction in expenses of $100,000. Both of those changes are related to leasing the first floor of this building and essentially the timing of when that lease and rental income became effective versus when we were anticipating that it would when the budget was originally developed. So overall, as I said, what these adjustments result in is a balanced general fund budget, which is essentially where we are today, where our revenues plus our transfers in equal our expenses plus our transfers out. The projected reserve balance at the end of the fiscal year remains right around $25 million, or about 12% of our net budgeted expenditures. And that concludes my presentation, but I'd be happy to take any questions or input that you have.
Questions? All right. And as always, the work is excellent, and I truly appreciate your time in coming before us. Thank you.
Thank you. My pleasure.
With that, the next meeting for the Finance Committee is 28 March, and at 5:30 p.m. And is there any other information relevant to this committee?
I just want to apologize for my tardiness.
Was that to me personally?
To you
Because
and to
I took it.
To my colleagues and to the rest of the people here.
Oh, well, I'm still concerned about my feelings, but okay. Thank you, Director Wood. We're adjourned. Thank you.